help you decide if buying a home now is right for you. I'm Andee Toronto, and today I'm going to share with you everything you need to know to take that first step in your home buying journey. Thank you for downloading our recorded webinar. Let's get started and let's make it possible. 8 p.m. So our mission here is to create experiences that matter. Every interaction for us is personal. It's crafted for our client. So not every client is going to fit into just a box. We do look into credit, down payment options, different loan programs, like I said, to make sure that it meets your financial and long-term goals. We are not a transactional company. So some of my clients I've had for years. It's important that we keep in contact. We'll always follow up with you to make sure you have the best rate available. We'll update you on values. If you're able to remove mortgage insurance, we'll update you. So we don't hand over the keys or close your transaction and say, have a nice life, we made it, good luck. No, we will always be in contact with you, updating you on the market and making sure your loan is the best loan for you at that time. So our agenda today, we went over who we are and what we do. We'll discuss buying versus renting. We're going to chat a little bit about how a loan payment breaks down, the anatomy of a loan payment, different types of loan, how to qualify for a loan. We will touch on credit as well, going through the loan process. Where do we start and where does it end? And then what's next? So kind of went over a little bit about myself. Real estate agents are very important as well. We'll dive a little bit deeper into that, but it's important that you have an agent that's going to represent you as a buyer, that they're going to negotiate on your behalf. So you always want to make sure you have a buyer's agent. Some clients think calling that agent that listed that property may give them a leg in. It may at times, but it's important to remember that that listing agent is also representing the seller. So there could be some gray lines there with trying to represent both. It's a good idea to have a buyer's agent on your side to protect your rights and make sure everything is in line and fair. Choosing a lender. So you want to choose a lender that best meets your financial goals and needs. So do they have programs, a lot of different programs that are going to make sure you get into a home, you're comfortable with the payment, it's not a cookie cutter 20% down, that you want to make sure there's options. Are they a mortgage banker or broker? We'll dive into that a little bit as well. How long have they been in business? What's their reputation? Definitely check out lender reviews, loan officer reviews. I am on Google. I go to our website at teamandee.com. We have a link there with all of our reviews as well. APM has a lot of reviews. Definitely check out lender reputation. Will they consistently communicate with you? This is important. You want to make sure your loan officer and lender is keeping you up to date on what's going in the transaction, but even prior to that, your pre-approval as well. Make sure you understand everything. And when you're in a transaction, they're keeping not only you updated, your agent updated, the listing agent updated, as well as escrow. Everybody needs to remain on the same page and informed as to where that transaction is to make sure you are closing on time. Will they work with your agent on your behalf? So it's kind of going back with that as well. Just making sure there's a solid team here, everyone's working together. Will they close your loan in a timely manner? You want to make sure that your lender, if you enter a contract stating you will close a loan in 30 days or maybe even less, 21 days, you want to make sure that your lender can meet that timeline. Can they effectively close? Or what are their turn times in underwriting and processing? So make sure they can close your loan in a timely manner. So bankers versus brokers. A mortgage banker will control the transaction. They have competitive rates. They typically lend their own money. They are just a mortgage banker, as a bank is doing mortgages. They have checking, savings, CDs, etc. Your brick and mortar banks. They do fund their own loans. They have the decisions that they can make with the customer, which brings value. They approve, draw docs, underwrite in-house. Some of the negatives could be more stringent guidelines. So with some of the banks, they just have a set of rules of their guidelines, and that's what they go off of. Their appraisals could be more conservative at times. They are definitely limited on programs, and it just depends. Their rates, they could be in line with the market. They could be out. It just depends on what that bank wants as far as loans. If they don't want any adjustables, you might see a higher rate with them just to deter those type of loans. A mortgage broker has access to multiple programs, multiple rate options. They shop. It's almost like an insurance broker shopping multiple carriers to make sure they're getting you the best rate and loan program. However, they lack control of the transaction. A lot of them are not effective with communication, especially online. Online brokers, you'll fill out an application and you may not hear from them. They also don't underwrite, draw docs, or have the ability to fund their loans in-house. At APM, kind of a hybrid of all of this. We are mostly a mortgage banker where we make the decisions here. We also have correspondent relationships with the banks. So the banks trust us in funding and underwriting and approving loans on their behalf. And then we also have the ability to broker your loan out to different lenders as well. The broker channel is very effective as well. We have very close relationships with some of these lenders, which you may have heard of, Rocket Mortgage, those type of lenders where we work closely with on those and can handle those transactions. So all three here give you the best product options at the best rates. Choosing a real estate agent. This is going to follow the same bullet points as choosing a lender, right? The first one's a bit different and important. You want to make sure that they serve the area you're interested in. Do they understand the differences in blocks? If you go 2 blocks from this house, does it change the values up or down? Make sure they really understand the area you're looking to purchase and they're well versed in that area. Do they have experience in the type of property you're looking to purchase? So this is important as well. In lending, we can finance a 1 unit to 4 unit. So a 1 unit would cover a single family residence, a condo, a townhome. Then we have duplex, triplex, and 4 unit properties. I have a lot of agents that have come to me in the past saying, great, our client is looking to purchase this 5 or 6 unit apartment building. That is now commercial. So you want to make sure that they understand the different types of property you're interested in purchasing for the loans that will go with it and available to that type of property. Do they work as part of a larger team? So Keller Williams, Berkshire Hathaway, some of those big companies also have large teams within them. So you want to see if your agent is part of a larger team. If you're out on vacation and we happen to get into escrow, who's going to handle my transaction? Make sure that they have a team behind them that can help assist if they are out. Same thing here. How long have they been in business? What's their reputation? Make sure you want to check their reviews. Will they consistently communicate with you and all parties involved in the transaction? Same thing here. We all want to be on the same page, communicating with each other to the ultimate goal, which is closing your transaction and getting you into that home. Will they work with your loan officer on your behalf? So same thing here as the lender. So advantages of buying versus renting. Right now, renting is extremely high. We know that. We also know that buying just kind of slowed down a bit this year, coming from extremely high property values and appreciation, where multiple buyers were looking to purchase just one property, which was causing that purchase price to go up very quickly. So now we're starting to see things slow down. We're seeing more homes come on the market. We're definitely not seeing depreciation. We can chat a little bit more about that on a one-on-one. But difference in buying versus renting. Buying, you've got property tax and mortgage interest that can be tax deductible. I'm not an accountant, so refer to your CPA on that. But we all know that rent is not tax deductible. That we do know. Your property, once you purchase a property, it earns equity. So all that appreciation we saw over the last couple of years is now equity for those people that own that home. So their value increased. And over time, it continues to increase. You may see, dips, but for the most part, your home is always appreciating. So creating savings as you're paying down your mortgage, so to speak. There's no equity earned in renting. You are giving somebody else that equity. You're paying their mortgage. So you can, going down to the third item here, control of improvements to the property. So you can do whatever you want to your property as long as it's within county, guidelines on additions and all of that. But you can change the paint. You cannot make these improvements to a property that you don't own. So unless your landlord is okay with it, but a majority of stuff, all the improvements you can do if you own that property. And then you have pride of ownership. Friends come over and yes, I own this. So that's a big one as well. The portion of the payment. So this is the anatomy of a mortgage payment. And it breaks down into 3 categories. There could be a 4th if there's mortgage insurance. We'll kind of go over that a little bit. But main portion is principal and interest. This is what you are paying back to the bank for the amount of money you borrowed. So principal and interest. Your next line item is taxes. You're going to pay property taxes. So here in California, the rule of thumb is your taxes annually will be 1.25% of the purchase price. So you're going to take your proposed purchase price, multiply that by 1.25%, and you're going to have your annual taxes. You can then take that large number, divide it by 12, and that's what your monthly portion of your taxes will be. Every area has a different tax rate. Once you start looking at different properties, we'll pull up those rates. But during a pre-approval process, we use that standard 1.25%. So insurance, it breaks down the categories here as well. So main insurance is hazard insurance, or also known as homeowners insurance. This is similar to car insurance, where you're going to have your deductible. The payment can be high as $125 a month. On average, we see $85, but it's really going to depend on what you pack into that policy, just like an auto. Mortgage insurance is applied if you put less than 20% down. So, myth is, do I need 20% down? I heard I need 20% down to avoid mortgage insurance. Mortgage insurance is $400 or $500. That's incorrect. You do not need 20% down to avoid mortgage insurance. There are options where you don't have mortgage insurance, and we can go into those options during a one-on-one consultation. There are also myth that it's about $400 or $500 a month. There are different options on mortgage insurance, and we can go over that as well. And then if you're purchasing a condo, the last item here are association dues. Every condo has association dues. What does it cost to keep up common areas? Is there a pool? Is there a hot tub? Is there a tennis court? So every condo and association will have different HOA dues. It really depends on the amenities. So note about mortgage insurance. Typically required if down payment is less than 20% down. Some programs don't require. So again, we can set up a one-on-one and go over those programs. There are also various insurance programs available where it's lender paid or borrower paid. This is also speaking of mortgage insurance. So there's different options there. Some loans allow you to remove your mortgage insurance upon reaching a certain equity threshold. We can break that down as well. There's multiple channels on reaching that equity threshold, so we can chat about that on a one-on-one. Types of loans. So another myth is there's just a 30-year fixed, 20% down, and that's it. So that's wrong. There are different loans. First one here is conventional. This will allow you to obtain a loan up to, this number here is 548,250. The loan limits are increasing. The next loan limits that are coming out right now, we're hearing that the conforming loan limit should be around 715, meaning you can go as high as 715 on a conventional loan with as little as 3% down. This would apply to single families, condos. A PUD, P-U-D, is like a townhome. So we'll determine if it's a PUD or a condo when you get into escrow. Now, where it has at the beginning here as high as 822, that loan limit we're expecting to go over $1 million as well. So with conventional, there is very little down payment, and you don't have a lot of hoops you need to jump through as you would with a jumbo loan. So we'll go over jumbos as well. Government, you have FHA, VA, USDA. Common myth with FHA is you have to be a first-time home buyer to get an FHA loan. That is not correct. You can own a home, sell it, turn around and want to purchase another one with FHA. You can currently own a home, want to rent it out and purchase a new primary, and you can use FHA financing. The rule behind FHA is they only want you to have one loan at a time. You do not need to be a first-time home buyer. VA is for our veterans. This one you do need to be a veteran. We will ask for what's called a certificate of eligibility or a DD-214. If you are a veteran, you know what I'm talking about, but that loan is specific to veterans. And then we have USDA. This is properties that may be on more rural land for those loans. And then conforming versus jumbo. So this is loan amount driven. Again, the conforming limit is going to be 715 is what we're speculating. Conforming high balance will be over $1 million. They haven't really leaked any of that, so we don't have an indicator of, just we know it might be over $1 million. Anytime you exceed those limits, you are now in jumbo world, which is going to require as little as 15% down, mostly 20% down on jumbo loans. First-time home buyer. We have a wide variety of programs with this. First-time home buyer, again, can go to a down payment assistance. Now that is first-time home buyer. And the definition of first-time home buyer is someone that has not owned a home or property in the last 3 years. So if you purchased a home, you sold it, you rented for the last 4 years, you are now considered a first-time home buyer. You can take advantage of down payment assistance programs and all of the other avenues we have for first-time home buyers. Fixed versus adjustable rate. I think fixed rate, everybody knows, is just, it's a fixed rate. It will not change. The only way that payment can change is if your taxes are increased, your property insurance is increased. That principal and interest payment that we went over a few slides back will always remain the same because it's based off that fixed rate. A fixed rate is typically higher than an adjustable rate, and they are a more conservative option. So if you think you're going to be in the house forever, I would say take a fixed rate. If you're afraid of the market and what rates may adjust to, take a fixed rate. You won't have that worry of what will my rate change to with an adjustable rate. Now, adjustable rates typically have a lower rate and start rate than a fixed rate. So it just really depends on which product you're looking at. If you'd like to schedule a one-on-one, we can compare a fixed rate to an adjustable rate, see how much lower it doesn't make sense. We'll dive into the pros and cons on that on a one-on-one. But the rate does change, so it's fixed for a certain period of time. It could be fixed for 5 years, 7 years, or 10. After those periods, it can adjust to what market rates are. Now, there's caps to that. There's limitations of what it can adjust to per year, and we can go over that as well on a one-on-one consultation. Types of loan programs. So FHA is government insured. You do not have to be a first-time home buyer. You can go as little as 3.5% down. There are rehab and renovation loans available with FHA. So if something needs some TLC, we can look at borrowing the funds to fix that place up for you. FHA does allow gift funds. So if a great uncle wants to give you some money to purchase a home, you can use 100% of that very nice uncle's money to put down on the property. There are no cash reserves required at closing. So cash reserves, just to touch a little bit on that, some loan programs want to see that you have money set aside. So on a rainy day, do you have 12 months worth of mortgage payments in an account somewhere? Savings, 401, retirement, do you have some money saved up? FHA does not require that. FHA will allow as low as a 620 credit score. So some other programs want you to be in the 700s. FHA does not. You can go to 620. VA, again, is for a veteran and spouse only. 0 down. So VA, you can put 0 down and get 100% financing. You do not have to be a first-time home buyer. With VA, there is no mortgage insurance. FHA, you will have mortgage insurance. VA, there is no mortgage insurance. USDA, again, is in more rural areas. There are definitely certain areas that this loan is available in. 100% financing as well. You do not have to be a first-time home buyer. We can go with a credit score as low as 640. And there are some income limits that apply. We can discuss that on a one. Down payment assistance programs. These are great programs for first-time home buyers to utilize the grants that are available from the state of California to assist you with your down payment. We can go in depth on these during a one-on-one to see what you qualify for. The newest one this year you may have heard of is a 10% down gift from CalHFA, which is not repayable. Those have income limits, as do most down payment assistance programs. Again, we can go into that on a one-on-one consultation to see what you qualify for. But provides 3 to 5% down in your first mortgage. There's no repayment necessary in most cases. Proceeds can be used for down payment or closing cost. So you can do a hybrid. If you have your own 3.5%, but that's all you have for down payment and you need assistance for closing cost, we can assist you. Closing costs are typically higher than some of the other loan programs. We'll go over that. And you don't have to be a first-time home buyer. There are limitations on some of the products within these programs where you do, but we also have some available where you do not. So this is going to kind of go over the different programs that are available. Cal Plus is within the down payment assistance program that provides 3% of the loan amount to be used for closing cost as well as down payment. So this is a second lien that would be repaid after you refinance, pay off your home, or sell your home. So qualifying for a loan. We're going to go over some credit, income, assets, property, what an appraisal is. So credit scores and how they're calculated. The most important thing to remember here is payment history, credit utilization. So payment history accounts for 35% of your score. You have a card that you opened when you were in college, you don't use it anymore, don't close it. That's absolutely helping you. The longer you have these cards open and show payment history, the length of the credit, that all helps. Then the next most important piece is amount owed. You want to keep the amount that you owe on these credit cards at 30% or less. So to keep numbers easy, you have a credit card limit that's $1,000. You want to make sure that that balance is at $300 or less to maximize your credit score. Once you start going over that, the bureaus think that you're using credit to buy and you just don't have any cash. So the score will start coming down. Obviously, making the payments on time is very important, and new credit. So new credit helps. You may see it lower your score at first, but as that you making payments on that credit card and it seasons, your score will go up. So qualifying for a loan with credit, it's really important. We have programs that can go as low as 600. You've heard the lower the credit score, the higher the interest rate. Yes, that is typically the case. So you want to make sure that your credit is pristine, you have great credit. We will go over your credit profile with you. We will look at ways to immediately improve those scores. So again, a one-on-one consultation, we can do that for you. You want to make sure that you don't have any open judgments or tax liens. This is an absolute hard stop on lending if there's a judgment or a tax lien, because once you own a property, you are on title of a home, this judgment and or tax lien will be immediately attached to that property. It will push your lender into second position to be paid off in the event of a default, so the lenders will not do that. So you want to make sure if you have any judgments or tax liens that those are paid. No one open and active credit line in the last 12 months. So if there are no open or active credit lines in the last 12 months, you may have a very low score or no score at all. So it's good to have at least one. So specific waiting periods for derogatory events: foreclosure, short sale, bankruptcy. So in a foreclosure, there are different waiting periods for different loans. So as you can see, 7 years from foreclosure on conventional. It's only 3 years with FHA and 2 with VA. Short sale, you purchased a home, values went down. We don't really see this now, but it's very big. 2008, 2009, during that crash. So you purchased a home for $500,000. It dropped. It was only worth $300,000. The bank said, okay, sell it for $300,000. We'll take a loss. So the waiting period on that is 4 years conventional, 3 years with FHA. Some exceptions apply. We can dive deeper into that if needed. And 2 years for VA. Bankruptcies, 7 and 13. So you can see here a 7 is going to have a longer waiting period for all 3 loan programs than a Chapter 13. So you have 4 years conventional, 2 and 2 FHA and VA, and then it drops to 2 years and 1 year for both FHA and VA. So how does a mistake on your credit score damage or lower the score? So here it shows you a maxed out credit card. Again, that's credit utilization. So anytime your credit card is over 30% of its limit, it's going to affect your score anywhere from 10 to 45 points, depending on where your score is currently. The 30-day late payment on a credit card could affect your score anywhere between 60 to 110 points. And also in auto, I want to loop in here, auto lates will also, they will affect your score a little bit more than what you're seeing there as well. So make sure that is always paid on time. Debt settlement, 45 to 125. Foreclosure and bankruptcy, these are big ones. So anywhere between 85 to 160 points on a foreclosure, and a bankruptcy could drop your score from 130 to 240. Very important. Credit improvement. So again, review your credit report annually. If you ever have questions about it, we can help give you pointers as well. If you schedule a one-on-one consultation, we'll definitely go through that credit report with you line by line, talk about what we can improve immediately, what may take a little bit longer. Pay your bills on time. This always helps your score. Again, that's the utilization. This is an immediate increase in your score. So if you have a credit card that's a $1,000 limit, it's maxed out, bring that down to $300 or less and you will see a change in your score right away. Keep a good mix of credit. So revolving installment, so credit cards, auto loans, or maybe even just a regular loan, small loan from the bank, personal loan, that's an installment loan. Don't close unused accounts. So this goes back to You got that credit card out when you were in college. Don't close that account even if you're not using it. Try to go out to dinner on it, but don't close it. The longer they're open and used, the more it helps. Minimize inquiries by applying for credit only when necessary. So this is also a big one that can increase your score anywhere from decrease your score anywhere from 3 to 10 points. So when it comes to inquiries and you're out shopping for new furniture, make sure you want to buy that new couch or that new bed before you allow them to run credit. We can discuss how mortgages and auto inquiries affect your credit on a one-on-one. They don't have as big of an impact as some of the smaller ones with revolving. If shopping for a loan, focus in a 2 to 3 week period. Use your credit sparingly and wisely. So I think here I would say diversity, right? Use the different cards. Make sure you're not going over 30% of the limit on just one card. So next section, we're going to go over income and employment. This is what we use to calculate your ability to repay, a debt to income rate. Typically, we want 2 years of employment is required. Same line of work is preferred. Schooling we can count as job history. So if you're in school, getting that degree or getting that certification to enter the job field that you want, we can use that. We can discuss that on a one-on-one. Commission, overtime, bonus. We must have a 2-year history receipt on this. We cannot use it if you just got your job and this new job is giving you a bonus, or you got promoted and now this promotion comes with an annual bonus. We need to have it for 2 years and see that it's likely to continue. Job gaps. That's a big one. Myth, again, is I haven't worked, I just quit my job. Do I have to be on this job for 2 years? No. So as long as you're within that same field, you went to a new job because it was paying higher, we can go off of that new job immediately. Self-employment. So self-employment requires 2 years of Schedule C or business returns. If you own greater than 25% of the business and it is an S Corp or partnership, LLC, we will need to see full business returns. If the business has a license or a permit, we will ask for that license or permit. We'll want to see that it's there for 2 years. If not, we'll typically ask for a CPA letter, somebody that can validate that your business has been established for 2 years. Payments and income. So this is debt ratios, and this is how we calculate them. We take all of your payments, the ones that are on the credit report, so the revolving, the credit card payments, we take whatever payment is there, student loans, installment debt, so autos, we add that up, and we also add the proposed mortgage insurance, the proposed principal and interest payment. What are the taxes? What are the homeowner's insurance? We add all of that up, and then we divide that by your income. That is how we come up with a debt to income ratio. So in this example, we have Mr. and Mrs. Smith that make $90,000 a year. Their car payment's $500. They're looking to purchase a place for $350 with 5% down, and the interest rate is 4.25. So their principal and interest payment, $1,636. This chart kind of breaks down everything, and you'll see at the bottom where it has the car payment as well, because that's the only item that was on their credit report, and then it has total. So we'll take that $2,653 and we'll divide that by their monthly income to come up with a debt ratio. So you may hear front end ratio and back end ratio. So the front end ratio is just your housing payment. So what is that new mortgage with taxes, insurance, mortgage insurance divided by income, and then you'll have the back end, which is all the expenses. Assets. These are what you're using for down payment, and reserves if you're in the jumbo world or if you need reserves. So qualifying for a loan and how we look at assets. we need to verify your funds. We need to make sure your down payment funds are coming from a verifiable source, whether it is savings, a 401, an IRA. If it's a gift from that great uncle that is amazing and giving you all that money for down payment. If it's coming from down payment assistance, we do have to verify those funds. We also have to verify closing costs, and depending on the program, we may need to verify reserves. So acceptable sources of funds that I had just gone over is checking, savings, stocks, mutual funds, 401k or any retirement account, and gifts. Down payment assistance as well. Gifts, when allowed by the program, most programs do allow gifts. We can dive into how much each one does on a one-on-one consultation. They are acceptable from family members only. So we can't have your neighbor giving you gift funds. So it does have to be a family member, and we do need to show a paper trail. So where did your family member get these funds from? The property and your appraisal must be equal or greater than the purchase price. So when you're going to purchase a home, this is why it's also important to have that buyer's agent. They're going to look at the list price, the price the listing agent set for that property. Does it conform with what other homes are selling for in the area? So they will do an analysis of current or recently sold homes in the area to make sure that that purchase price is in line with what's sold and it's not inflated. Because you're going to get an appraisal. If the appraisal doesn't come in at or greater than that purchase price, well, we're going to have a gap that we either need to come up with in cash. So to keep things simple, you're purchasing a property for $500,000. It appraised for $450,000. We have a gap of $50,000. Now we need to negotiate with the seller of how do we come together to bridge this gap. Does the buyer need to come in with $50K? Is it going to be $25 on each side? Is the seller going to lower it by $50K? So again, a buyer's agent will do that negotiating. The property must be in good condition unless purchased as a renovation. The renovation loan I mentioned earlier. So an appraisal is going to determine the condition of the property. They are not going to go into the electrical panels and do all that. That's a home inspection. That's something different. But an appraisal, they're going to walk through, they're going to take photos of the rooms, they're going to make sure water's running, electricity turns on, just make sure the overall health and safety issues are not a cause for concern with the property. Certain loans require very specific condition of property. Most appraisals follow the same set of guidelines. Where it differs a little bit is VA. They want to check mechanical systems. Are they usable and safe? Is there adequate heating? Is the water safe? Is it sewer? Is the roof leaking? Does it need repair? Does it look like it's at the end of its lifespan? If there's basement or crawl space, is it dry, clear of debris, and properly vented? Is there safe access from the street? There could be more requirements. We can dive into those if you're interested on the one-on-one consultation. FHA is going to be very similar to VA, not as strict. They're going to look for health and safety items, as does conventional. They're going to want to make sure the driveway and the lot is graded and away from the house. Is there egress exterior for all bedrooms, meaning you can get out of the bedrooms in a case of fire or emergency? The stairways, are there handrails? Most houses do. So some of these guidelines, all homes conform, so it's not really a need for concern. But again, is the roof in good shape or does it need repair? So the loan process, you'll start with a pre-approval. This is where we begin with the one-on-one consultation. We talk about your goals, we talk about down payment options, we run credit, we go through that together, and we find a loan program that's going to best fit your needs currently and long term as well. So we're going to look at the credit, we're going to look at the income through W-2s and pay stubs. If you're self-employed, we'll need your tax returns. And then we'll move forward with issuing a pre-approval letter. From there, you'll work with your agent to find a home. So they will take you out to see the homes you're interested in. Once you're ready to write an offer, they'll draw up that paperwork so you can submit a formal offer to the seller. Once you get into escrow, you're going to provide us, or your buyer's agent will be in contact with them, will provide us with the purchase contract. We then will put all of that information into the system to send out initial disclosures. So we're going to get estimated closing cost from title and escrow. We're going to have that down payment that we discussed for your loan in there, so you can see how much cash you're going to need at closing to purchase the home. What is the interest rate on that day? What is your payment? We'll have all of that in initial disclosures. From there, your loan goes to processing. So you're going to start searching for insurance at this time while a processor reviews your documentation. Make sure everything's in there so that when an underwriter picks up your file, they can approve your file from underwriting. This is all in-house again, and you'll have a formal approval. We will move to appraisal and inspections. It's where we make sure the value meets your purchase price. Inspections is going to be where an inspector is going to check the electrical panel. They're going to check the water, the gas meter. They're going to make sure all of that stuff is great. If there's crawl space, they're going to go under. If there's an attic, they're going to go up. They're going to do a very thorough investigation on that property to make sure there's nothing wrong with it. It doesn't need any repairs. Underwriting is kind of lumped in with processing there. So that's the step where the underwriter will make sure that the file meets lending guidelines. Once an underwriter approves your file, it's a conditional approval. They may ask for an updated pay stub, an updated bank statement. Oh, your great uncle is giving you gift funds. I need to get a gift letter and I need to see where those funds are coming from. That could be some of the conditions on an underwriting approval. Once we gather all that documentation, we send it back in for a final approval and we issue an initial closing disclosure. This is going to be very similar to initial disclosures. It's a 4 to 5 page document that's only going to list the final closing fees and what the final amount is that you need to bring into closing. When you receive this CD, it is critical that you review and you sign it and return it as quick as possible. There is a 3-day wait period from signing that closing disclosure to when we can actually have you sit down with a notary and sign your final documents. I will let you know once that CD is issued. We will go through it together. We'll sign it so you don't have to worry about missing a mark on that. So signing, closing, and funding. This is when we draft your loan documents. You're going to sit down with a notary or go into escrow and sign all the final documents for your loan. From there, your loan documents will come back to us. We will review, make sure everything was signed properly. Let's see, this is CD wait period. This is the 3-day wait period I had mentioned. And as long as we have waited the 3-day wait period, which you cannot sign your loan documents. This is a little bit out of order. I apologize. But you are going to funding. Your loan will fund as long as we have all signatures, everything is needed, and your loan will record. The title of that property will be now in your name as the listed owner with the county and the records. So at that point, we are going to issue a big congratulations. You have completed the loan process and you are a brand new homeowner. So what's next? So next would be your starting point. What do you qualify for? What are your needs? This is where we can schedule a one-on-one consultation to make sure that we can get you pre-approved. make sure your credit's in line. If not, we'll start mapping out a short roadmap, maybe 3 months, 6 months to a year, on what the steps are that you need to complete to get to that pre-approval. From there, we'll introduce you to a buyer's agent. If you have somebody in mind, great, introduce us so we can begin working with them, but then you can start shopping for a neighborhood. From the neighborhood, you can start shopping for a home in that area. You can start writing your offers. Keep your loan officer in the loop. I'll probably bug you to remain in the loop so that everything moves smoothly. And then we'll go through that process that we just mapped out a slide before, and we'll get your loan closed. So again, I am here to help with anything you need, any questions you have. Please schedule a one-on-one consultation. We can go more in depth into your personal profile, what you qualify for, what loan programs are available for you, and down payment. So if you have any questions, please feel free to book that one-on-one consultation. My number is here, my email is here. Check us out at teamandee.com. We are here to help and guide you through the next step, which is pre-approval, and be on the road to homeownership.